Okay, good morning, folks. It's Monday, September 19th, 2016. We're going to be reviewing the cable from last week. We're going to be looking at the high resistance liquidity run, the impact it had on price, and then we're going to contrast that with that of the low resistance liquidity run that we saw transpire on the pound dollar. If you haven't noticed, it's a rather light news day today. So we don't have anything in terms of big moves, big explosive type events expected for price action today. We do have on the cards for this week, we have a big impact event regarding the interest rates. Okay, so you need to be paying attention to that. Look on your Wednesday's calendar and you'll see what I'm referring to. The dollar, let's go out to a daily chart real quick and get a macro perspective on what was going on and what may be unfolding. Okay, we had noted months ago on my YouTube channel. Why is this thing not doing that? Okay. This area up here. Okay, we have equal highs. Again, if you've already watched the tutorials for this week past, okay, I gave you what you should be focused on right now. Going through your charts, looking for areas in which stops would be resting, which is a liquidity pool. Where there is a quick movement in price, that's a void or a liquidity gap. And then a expansion point of which the market moves away from a specific level. That's going to begin your study of order blocks. Okay, and by having those ideas on your charts, and you're not going to see every one of them if you're new, and even those that are pretty versed in order blocks, some of you still don't know which one you should be focusing on, and that's what we're helping you do this entire month. We get into the second month, we'll be going into even deeper understanding about all those liquidity points and references to institutional order flow, and then coupling that with risk, because then we're going to start working into trades, looking for entries, stops, and all that business. And in the third month, we're going to be looking at targeting, and we're going to be adding all new dynamics to the things you've already understood in the free tutorials and up thus far in this mentorship. And then around the fourth month, we start leaving what you already think you know and going into a little bit deeper waters, slowly but surely. And in the seventh month, we will be in new content no one's been exposed to in this community or in the free member section outside of our group. All right, so looking at what we have, last week we had 96 big figure as a target, and if we were to get any legs on the upside, that means expansion. We were looking for it at 96.25 to 96.30. That would be these highs back here. It went right into the 96 big figure, consolidated, and we've had a little bit of retracement in here. I don't think that this is the high. I think we're probably going to hang around in between the order block that's created here, which is the down move in here. All of this is two candles on a daily chart, okay? So it's this entire little section between the two candles. So in reality, it looks like this. Now, before I get into that, let me do this. The down candle, I'm sorry, the bearish candle, okay, or good grief, listen to me. The bearish order block, which is the up candle, now I'm really confusing you guys, the up candle right before the down move, okay, up movements is where the smart money sells into. They sell as the market rallies up. So we look for these ideas, okay, in price action right before the move that takes place going lower. We don't have to be a participant of that initial move. All we need to know is that this movement took place. So now we understand where we got to focus our attention on, right back here at this up candle, which is a bearish order block. Price has gone through that here. Okay, very important. This up candle, which is a bearish order block, even the larger one back here, okay, which is more significant than this one. Now, why is it more significant? Because this candle is inside its high, the close of it, and the opening of that, which is the body of the candle, not so much the wick. We don't care about that. The body of the candle is inside of the total range of this up candle, which is right before we get to the highest high in this entire range here, this high and this low. Okay, price on this day here, Friday, expanded up through this candle here, and it consumed entirely this body of this up candle. So what this is indicating here is institutional order flow is slanted to the upside. Now notice it just fell short of breaching these wicks in here. So the liquidity resting just above these highs, and more importantly, these highs over here. These are the ones that we've been watching for months now. It's just we've been in a very long, extended consolidation, which can tend to happen sometimes, and you have to just weather that. You got to go through it. The idea of these clean highs in here, it's just too neat. Actually, let's not use that one. Let's use this. I mean, look how perfectly tidy and perfect. It's just too perfect. The high, 96.53, and the high on this candle, 96.53. Folks, price does not leave levels like that in there without actually coming through it eventually and knocking it out. Now, they can stay there for a long time until institutional order flow makes a move towards it. But we know when we start getting close to like this, it's really high probability that they're going to want to reach up in there and clean that out. Now, just above these equal highs and to the left, we have this price swing down. Just like I mentioned over here, right before the down move, your eye needs to be trained to look at the up candle right before the down move, because that's exactly what the banks have sold. So if the banks are selling in up candles, we're focusing primarily on the low at 96.80 and this this liquidity pool. So we have a liquidity pool resting just below a bearish order block. So between these two reference points, there's a lot of interest to expect the bank to draw price up into that. So you take these levels over here, bearish order block, liquidity pool, where there's equal highs, there's going to be stop loss orders resting just above these highs. What kind of stops is it going to be? It's going to be in the form of buy stops. Why is it buy stops? Because the market has been going lower, and as the markets drop lower, we have to role play. Again, in your mindset, you are the market maker. So anyone that's short, they're going to learn to do what? In technical analysis, they're going to trail their stop loss just above a recent high. So back here, this is a high that would have been used and may still be using for placing their protective buy stops on their shorts on dollar. It got real close to running it here in proximity to these highs, but then it turned back around, gave them a sense of security. It's okay. Now these same stops in here may have fractaled. I mean, they may have fragmented and created a new lower fractal high. So stops that would be resting here in the form of buy stops protecting shorts, they may have moved them down to this level here. So there's two layered liquidity pools in the form of this high here and this high here. Okay, we mentioned last week and the week before that we had these order blocks in here, and we had to wait and see what was going to happen in regards to institutional order flow. What's going to happen, because we were stuck in this bullish candle here, which is the down candle prior to the up move, and this bearish candle or bullish candle, which is a bearish order block range in here. Finally, Friday, we broke through it, but notice we did not take the stops here, and we have yet to come up into this area here. So we know there's a willingness to want to go higher, okay, because we saw a price show a willingness here. Then it recapitalized this down candle. Both of these candles are here. They traded into it, recapitalized it, and it expanded the upside. So now the hand of the banks have been tipped. In other words, if we were sitting at a poker table, their hand's been tipped to us. Now we know what kind of cards they're holding. They're most likely going to make a run on 96.25 to 96.30, and up to 96.55 to 96.60, and ultimately up to 96.80 up to the bearish order block. Now, if we get into this order block here, okay, if we go anywhere near the midway point, it's going through it and making new highs, because this isn't really that exciting in terms of a high either. It's just real lethargic, real slow. Let me just roll over and go lower, okay? Versus something dynamic where it's like this, stab, run away. Okay, see the difference in this? We move down quickly and immediately rejects it. We don't see so much of that going on here. It's just like, well, let's just go back down here and then come down lower, hang around, we'll capitalize for a longer term price leg higher, and then we'll start to resume higher. And I think that's where we're at right now with the dollar. I think we're going to possibly grind higher going into the fall. There's a lot of, well, I said it before I hit the record button. There's a lot of things going on, and I'm not sure if you noticed what month we're in right now, but it's September. And I said that we're probably going to see a lot of things going on in the United States that people in the United States are not prepared for. Things that you see in third world countries, things that you see in the Middle East, things that you see in Europe, okay, where they have people, doing things that are just they're uncharacteristic in the States. We also have a weird presidential election this year. We have two candidates that have really no reason to be elected to be president. So we have a lot of uncertainty, a lot of just weird things going on. Two bombs just went off, over the weekend in regards to New York. One went off there, and we had one in Jersey City. It's ramping up, okay, and all the telltale signs we've been following along for months. A year and a half ago, I told you that we were going to come into this atmosphere, and I don't want to see it happen. I hope I'm wrong, okay, but because of all these uncertainties, okay, it's going to cause a lot of folks to just be nervous. And when that nervousness comes into the marketplace, it's going to be a flight to safety, okay? In other words, they're going to be leaving risk asset classes like stocks and things of risk, and they're going to want to go to where they think it's safe, and that's going to be in the form of the dollar, okay? And that's going to cause the dollar to rally. That's going to be hopefully seen in the charts, because if it can suppress commodities, which is what I'm hoping for it to do, I'm hoping actually that we get a real surge in the dollar, and it really smashes the commodity markets down really, really low. Because once we get into the latter months of this month, okay, I'm sorry, this year, that'll set up some amazing buy scenarios for commodities. But it'll also set up some amazing shorts for foreign currencies. See, right now we're in a very long consolidation for the dollar. I mean, it's been weeks just sitting in this tight little range, and it's not going to stay in this very long. It's going to move, and I think what it's indicating here is that it's going to want to run for these highs here, even if that's all it does. And say I'm wrong. Okay, say I'm wrong, and it's all going to be cupcakes and milkshakes and gumdrops, and nothing's going to be happening, and everybody's walking around with teddy bears and balloons, and nobody's getting hurt, no bombs are going off, the elections go off without a hitch, and whoever's elected saves the world and ends world hunger and cancer and everything else overnight. Say that I'm wrong. Okay, say that happens. It's still a tradable condition where we can see where the market's going to be drawing liquidity. That's all we need. We just need to know where's the probability at right now, near term. And if that's all we can get and we can muster from the charts, that's all trading is. It's not your ability to know what's going to happen 6 months from now. I make all kinds of forecasts, all kinds of them, sometimes in private notes, and they don't come to pass. They're not trades. They're just ideas to use to frame the context of whether or not you take a trade. That's all. So when it comes to trading, I'm only really looking out about 1 to 2, at most 3 days. That's the horizon I like to look at, because number one, the market's going to do whatever they want to do. And I'm human. I'm going to be wrong. I'm not going to have the prognostication to be absolutely perfect, 2 weeks from now, a month from now. But if I operate on these daily time frames like we're teaching here, and I've taught ever since I've ever acted as a mentor and taught folks in the late 90s, I always start them off on the daily chart. And if you understand what we're showing here, let me get this off because this is not any more salient to what we're discussing. We may come back down here, okay, and find some support. I don't want to see it go down to the bodies. I'd rather just stay above and trade in here, okay, because really what that's going to be doing is mitigating the bearish order block here. All it has to do is come right back down and hit that. So the sensitivity on the downside for dollar, I'd like to see support form around that 95.65, 95.60 level. If we lose that, it needs to be monitored, and we don't want to lose the open on this candle here, which comes in at 95.33. So 95.35, 95.40 in that area. You want to be watching it on lower time frames. Make sure you don't lose any of those specific levels. Now it can sweep those levels. That means it can go down just a little bit real quick and then come right back above it. If it does that, then it's just stop running. There's no reason to be concerned about it. But as it's indicating here, I think that in terms of swing trading mindset, in other words, beyond the scope of day trading, because I know there's a lot of folks that are subscribed. You're all like, hey, look, I want to be in a longer term position. You're talking about intraday stuff, and I understand what you're looking for, but I have to teach you in a way where you can see the price actions unfolding in an intraday time frame. So it gives me a lot of sample size to show you what it looks like instead of waiting for a daily chart to unfold. If I just taught you in 12 months with a daily chart, I won't have enough to teach with. There's not enough price action to show you because it looks look how long it's been since July. So we have mid-July to now. So in 2 months, how much has really happened? We've only had about 5 setups. Now, if I did 5 setups or 5 conditions in the course of 2 months, you're obviously going to be on the lower end of your expectations being met. You're going to be like, this isn't worth it my time. This isn't worth my interest. I need to go and do something else. So I'm operating inside of an intraday teaching model because it gives me the framework and it gives me a lot of sample size to show you that you can see what's most likely going to happen. And anything you see in the intraday charts, that same thing is being done on a daily chart. It's been done on a weekly chart. And you just need to figure out where you are in your comfort level as a trader. But don't discount the importance because I'm showing you intraday price action that if this is only day trading, I'm not learning what I want to learn because that's a myopic view. You really, I said this beginning of the mentorship, you don't know what you think you should know. So I'm showing you a poll every 2 weeks so that way you're going to be able to give me reflection on what you think you're getting in terms of delivery. Am I meeting your expectations? You're going to look back a month from now and say, you know what, I was probably premature with my understandings and my expectations, and now I understand better really what was being shown to me. And in 2 months from now, you'll look back at those same interim reports and you say, you know what, I was really learning a lot more than I thought it was. So believe me, I know some of you are going to be very cynical. I know some of you are going to be, I don't think I'm getting what I thought I was going to get. You don't even know what you're looking for. Trust me, because if you subscribed, that's proof you don't know what you're looking for. Because if you did, you would have never subscribed to the mentorship. You'd already know how to trade. You'd be doing whatever you're doing. So when we look at these higher time frames, all these same things are the same things that I'm teaching in an intraday capacity. The only elements that are absent is the high correlation to time of day. But you also have day references in these time frames as well. For daily, you have the beginning of the month, the middle of the month, and the last week of the month. Okay, there's specific things I'm going to teach you about that. There's quarterly effects. Every 3 to 4 months there's something that goes on where it causes you to have a swing trade idea that comes to fruition. Then you have a yearly high and yearly low setup. Then you have 6 months highs and lows that you can trade. There's so many things that you don't even know what you're about to learn, but you have to give me time to get you there. So I just want you to know that I know what you're wanting to learn, but you have to get through a lot of other things to get to understanding what that is. And it starts by showing you, number one, where does price want to reach for? And if I can show you a lot of examples in an intraday chart, what I'm showing you here, if I would have taken this reference point over here where it says the daily, if I just block that out, okay, if you weren't aware of what the daily chart of the dollar looks like, you wouldn't even know if this is a 5-minute chart. You wouldn't know if it was a 5-hour chart, a 30-minute chart. You wouldn't know because price is price. It's not going to be anything outside of what it's going to deliver on every increment of time that you measure. You can't have barriers to your expectations by thinking, well, this is what I should have learned, or this is what I should know, because you don't know anything about what you should be learning. You don't have any basis yet. So use the studies that I'm giving you in the tutorials and in the teachings every single day in regards to intraday price action, and just understand that those same dynamics occur on the higher time frames. I know some of you just can't, you're operating businesses. Some of you are having jobs. Some of you just can't do it that time of day to be a day trader, but you know that there's movements on these higher time frame daily charts that if you could understand what you were doing, you could just do that. And that's fine. You're going to learn that. But you learn it by studying what I'm showing you in the intraday charts, because it's the same thing just occurring on a higher time frame chart. Believe me, I'm telling you, it's nothing outside of what you see me teaching in an intraday chart. That's the same stuff you're going to see being utilized on the daily chart. And that's what I said. I mean, don't worry if you're on the fence about what is you're thinking you're not learning. It's happening. You just don't know it yet. Trust me. All I'm asking you to do is just trust me. So if we know that the indications are that these stops are most likely going to be rated, okay, that's the first step to see if we're going to continue higher. Okay, if we break out and clear these old highs back here, we don't know if that's going to happen until we first get through this area of liquidity here. And we don't know if this area is going to be rated yet until this one's absorbed. Okay, so right now the only thing we have is an indication the market wants to go higher, and it's stopped just short of it. So to me, I interpret that as them priming the market, thinking, okay, well, this is resistance. So now anybody that would have had their stop loss down here, I'm sorry, up here, would have lowered it down to here on shorts. Anyone that's short in the dollar, they have stops resting above this high here, and they have it above here. Notice that we had a strong reaction from the lows up, and we've capitalized every new bullish order block, and we've cleared out the bearish order block over here and the one that's here. So institutional order flow is now bullish for dollar, even if this is a down close and it even comes down here and closes right on that level, or maybe it goes down a little bit lower. It's still bullish for institutional order flow. That means don't be thinking sell dollar, buy foreign currencies in this condition. Don't think that right now, because the underlying pinnings of the market are suggesting that this thing wants to go higher in regards to the dollar basis, the daily chart. Okay, so if we are a short-term trader, that means we're looking for the weekly range. We're going to be focusing primarily on the dollar making a low today, Tuesday, or Wednesday specifically, probably because of the interest rate news that's going to come out, whether they're raising interest rates or not raising interest rates. Frankly, I wish they would raise it up and just let the dominoes fall, and let the house of cards just do what it needs to do. But nonetheless, it's not my opinion that drives the marketplace, and it's not going to be yours either. But I want you to think about market structure, okay? We have a swing low here. We have another swing low here, and we have a higher swing low, okay? So what this is we have a short-term low, intermediate-term low, another short-term low. This intermediate-term low could potentially be a long-term low. Okay, it's been a while since I've talked about market structure, but we have now seen the market want to go higher. We've broken institutional order flow that was bearish near term. It broke to the upside now. So all of the interest really is now going to seek liquidity above highs. Why would they want to do that? Why would we feel comfortable expecting, why would we want to have this bias, if you will, okay, or directional premise on the dollar being higher? Because, and by the way, I'm not looking at the questions. I've not been looking at the questions since I started. So if you are sending anything there, I'm ignoring everyone because I want to try to stay on point. It's been very distracting when I do it, when I'm teaching live. Because we have taken out the bearish order blocks in here, we've respected bullish order blocks. We made a higher short-term low here to the right of a lower swing low and a higher swing low to the left of it. We have now potentially intermediate term or long-term low in market structure, while at the same time bearish institutional order flow order blocks have been consumed to the upside. They have not. We've not seen anything hold price back. It's moved higher. Sorry about that. So we have the expectations to see price expand and move higher. If you look at price like this, okay, we see the market's done this. We have a swing low, we have a lower swing low, we have a double low in here, but I don't reference this one because if we clear it out and reject it, this is, hang on one second. Sorry about that. Bella's trying to get the mailman. So we have the market giving us an indication it's want to move higher. We have two areas at which the market is now priced in bullish market structure. So we have a low over here. Let's look at it like this. Lower low, higher low, and this same phenomenon is happening over here, but it's happening higher than all of this market structure in the form of this. We got low, lower low, higher low. So we have this turning point, or basically a big swing low, and then a higher swing low. Okay? We have all of these highs that have not been touched or rated yet. So this is all this is a wind up, or kind of like a consolidation right before it expands up and comes after this liquidity, and potentially this one here. Okay, so the market structure is indicating to me that we're probably going to want to go higher and reach into these areas in here. What would negate this and say, okay, this is not actually happening and I need to change gears and either expect this consolidation to continue longer term or expect it to break down? We would have to lose or break down below this down candle right here. Okay, and it begins by having it do this. This candle's low, middle of the body of the candle. I'm using close proximity to these lows as well. And look how many times the order level has been touched here. The body, the wick of this candle, wick of this candle, wick of that candle, the bodies of these candles, wick, wick through it, bodies real close to it, wick, the wick on this down candle, and it's the middle of this down candle before this big move up. So if we lose, if we go below 95, I say 95.20. If we lose 95.20, then it's probably going to go into this consolidation a little bit longer term. Okay, and we would have to watch this low. If we lose this low, then the dollar's going to probably trade between the low that's created here and whatever high is formed over here. That would be the new range, and we would have to watch each respective return to support or resistance at that time. But for right now, as a forecasting portion of this mentorship, I think that the dollar wants to go higher based on the market structure that's being placed in the daily chart. And if you zoom out, okay, this is all happening near the end or bottom of this longer term consolidation. So we may be seeing the turnaround here. It's just adding more and more and more, and we may be resuming higher up longer term and looking for that $1, $2, $5, as much as $7 if we get some really crazy stuff happening in the U.S. So, and it could happen. I mean, we've got some really Wild West scenarios that's on the horizon with our country. So that's my spin on the dollar. So let's take a look at real quick with the euro, see what it's doing. Where's my yard chart? All right, let's go to a daily. Okay. I like the fact that we have this area down in here. I think that we're going to most likely want to reach into that. We do have the bullish order block here, the down candle, it broke through here, so we would be looking for downside objectives to 110.30, and then we also have 111.30. I think if we lose 111.30, you're going to be really paying attention to this one, because if we go down into the middle of this body of this candle, and also look at the wick on this candle, see how it hits it? Middle of that candle, it's sensitive. So 111.05, 111.10 to 111 big figure downside objective. We may see that hit this week. If we go through that on the downside, we're going to be looking for the 110s to 110.20. What was that level? 110.30. And with this wick here, I'm not concerned about that, because it's a high impact reaction to Brexit. But the equal lows, and here's what I'm looking at here: the swing low and this swing low here. So there's liquidity resting below that. Yes, you can use the wick too, but I'm not really concerned so much about that. I'm looking at the fact that this consolidation in here would have sell stops below it. So if we lose this low here, we would expect it to expand down through here, and kind of like what we saw in the cable, reach even farther and blow out the low that are equal lows over here, and fill in this void right there. So this big run up, it's exposed from this low down to the point at which it broke higher. So that looks like this. This swing low retraced in some of this up candle, but it didn't go all the way down to where it started. So this exposed range in here is a liquidity gap. Okay, so price will most likely want to come back down in there and return into that void. If we get down there, I don't know if we're going to punch through this low or if we'll just go into a consolidation. I don't know. I don't know that for right now, but it certainly looks like if we lose these levels in here, that's what we're going to probably see. Euro pound, before we look at cable, we have a return back to an area of institutional order flow. We had buy stops targeted last week. They ran those out, clearing out equal highs, as noted here. Price came through it. Now we're trading back at. Look at the bodies of the candles in here. It's respecting the bodies of the candle over here, not the wicks. Okay, we're more primarily focused on the bodies of the candles, and you can see how the bodies of the candles are being kept at bay. Okay, so this may be a modest support level to watch for further upside for euro pound, which means that either euro stays in consolidation and cable drops, or euro rallies and cable goes into consolidation. And speaking of cable, let's look at cable here. Okay, so we have market maker sell profile, consolidation, rallies up, reaccumulation, smart money reversal, low risk sell, distribution, sells off. On the 15th of September in our presentation, I said that when the market was down here, I said that I didn't want to sell it. Okay, I didn't want to go short, and I said that we were also in an area of redistribution, and if we lose ground, we're going to come down here and clear out these lows and go down into this area as well. It did all that Friday, and this movement here up was the reason why I said I didn't want to go short, because I knew it would want to go higher first. We framed that with that high resistance liquidity run that we had going on all through this entire little retracement. Now, I'm going to teach on this whole thing right here and bring this presentation today to a close. I'm going to try to keep it around an hour. Let me zoom in. In this area of consolidation, okay, price had already expanded lower. When we see these elements like this, it's starting to come down, okay, you have to think like optimal trade entry or retracement or return back to a bearish order block. That would come in the form of this right here. We have the up candle right before the down move. So this order block begins here with the body, And in the middle of the range, we're going to measure the body down to the lower end of its body. And the equilibrium is that first level right here, which I'm going to draw another line off this line segment. If I can get it to do it. Okay, so now I have two areas at which I want to look at on a lower time frame relative to this bearish order block. Now, if it's going to be good, okay, in other words, if a move is going to be dynamic, if it's going to be explosive, if it's going to be a lot of magnitude in terms of how far it moves and how fast it goes, generally there is going to be a stop run, okay, and that looks like this. You'll see a high, the market will create a high, and then, not that one, it'll create a higher high, so it runs out an old short-term high. Then after that happens, obviously that's a turtle soup sell or false breakout. But this is what you expect to see if you're bearish. You want to see this more than you want to see a bearish order block return to. You want to see this, because if it runs back for the stops, why would they want to go there? They want to knock those individuals that are already positioned short. So that break above an old high, we expect it just to go above it a little bit, maybe 10, 20 pips, and then roll through. But after it goes above the previous high, it can't spend much time there. It has to go there, knock the stops out, go in a defined range, 10 to 20 pips. It can maybe do 25, something like that. But generally, it's not going to be a whole lot of movement past it. And then you want to see quickly it go back below this previous high. If you see that condition and the market comes back up and retraces into the bullish order block or bullish candle right when it made the higher high, then that's it, like a loaded deal, easy sell, don't worry about it, get in there and just do it. But it doesn't always have to do this run on stops. This is the best scenario. That's why I like turtle soup, because if I know that I'm most likely going to see a lower move or a higher move, I'm going to look for that stop run to position it, because I know that's going to be the fastest movement. They're not going to spend time hanging around there. They're going to run the stops and quickly reprice higher if it's going to be a buy, or quickly reprice lower if it's going to sell off. Now, if you remember, we had the high resistance liquidity run drill that we were doing. We went long down in here. Okay, 132.02 was my fill. Okay, and we were looking for a movement higher, and we were expecting a run on the 132.50 level, and if it was going to spike, we could allow it to go up to 132.80. Okay, that would allow a spike through the mean threshold. Now the mean threshold here comes in at what? 132.52. That's 2 pips above what we were looking for in terms of the high resistance liquidity run, which was a run on the stops at 132.50, which we're going to go down to lower time frames and define all this and make it understandable. But for reasons now, I want you to know that we expect sometimes that mean threshold or the middle of the order blocks, it might spike through that. So we allow for some of that to occur. It may not happen. It may go right to the middle of the order block and then go right straight down. And like it did here, it fell short of it. Just by 2 pips, it just fell short of it. In fact, the actual high came in at 50. 32.50 was the high, and you see it, 32.50. Now I had limit orders to collapse the long in here that I was showing you high resistance liquidity runs and the effects of how it transpires in price. I wanted to give you an example how, yes, you can go through this process, and yes, it takes a long time to get through it, and it's not dynamic price action like this. It's still tradable, but you can't be expecting like these big events to occur when you're trading through it. It's slower. It doesn't want to move as explosive. It's really step by step, very methodical in the way it's trading. Well, if we have these understandings in here, and again, go back to the 15th on September and watch the video. I think it may be around the 7-minute mark. I think it's the 7-minute mark or 17-minute mark. I made notations last week. I wanted to talk about it, but it's in the 15th of September's video where we talk about the distribution area that we're in again, and we're in a market maker sell profile, and we'll come down, clear out these lows. Going into a 15-minute time frame, right in here, that's that mean threshold on the daily order block right here. That's what that level is. And in here is the order block itself at the bottom, okay, where you would expect to see selling to occur. So inside this shaded area, we're expecting another level of distribution. But if you're a trader, like most of you probably are wanting to be or consider yourselves now, if there's a move that we can trade, then why not trade it? Well, that's what we did here. We did a long with the expectation that we got to drive through all of this big block of efficiently traded price, all the way up into, and the highest of the highs come in $132.50 on that high, and every high in here is $132.50. Never goes above it. This high here, $32.50. This high here, $32.50. They would not permit one print above $132.50. So there was no willingness at all to see one pip, not one pip, to trade it back above this area of efficiently traded price range, which is a testimony to why I say I don't like to trade in these conditions, but you can take trades. While you're learning, it's going to be very beneficial for you to do it. And you'll be taking some trades that you think are low resistance. They'll end up becoming high resistance, but you'll learn by experience doing it. This element that we're using here for teaching the difference is when we have the willingness to see price start to grind through an old area of consolidation. That means all of this price action in here was efficiently traded, lots of back and forth trading. The only way we would reasonably expect to see an objective would be to see it go through to the other side of the consolidation to absorb any of the stops. It didn't give it one pip here on this. Now, some of you may have a feed that maybe it did go above it, but for this one here, it didn't do it. So I didn't get any exit on my limit, and it had to come down while I was sleeping, and it took me out at a small loss on the second portion, but the first profitable scaling out at 25 pips neutralized that, so I didn't have any really. I had a 13 pip gain on this move here. Okay, so it was a demo drill. It was only 13 pips that was salvaged. Once we woke up on Friday and we saw that the market had already moved lower, we were expecting obviously the market to break its lows and break down. It gapped here. Okay, and I wanted to see price come back up and close in a little bit of that range, and it didn't do that for me. It opened immediately at the gap and traded softer, and I didn't get any kind of retracement like I wanted to see. But in relationship to what this was, there was all this consolidation to trade against, okay, and we were in an area of distribution. So the upside is going to be limited, which is the reason why we didn't call for 33s and 33.50s and stuff like that. We were just looking for objectives where it could come up there and spike through, which would clear this area back in here, okay, and take us into a run on these equal highs here, and then reject because we were in close proximity of a breakdown on the higher time frame charts. So you're going to have to blend these things back and forth. When you hear if there's a 15-minute or a 1-hour setup that we're using, go out to your higher time frame chart and see where that may be lining up with the bigger picture, because we may be just taking it along in an area where it's a larger, longer-term bearish market maker sell profile, with like we're showing here, and you're going to see we're going to be able to work in both sides of the marketplace. Doesn't matter what those longer-term charts are suggesting, we can still find setups on both sides of the marketplace. So for some of you that are familiar with Chris Laurie's work, if you ever were a part of his, they don't really have a bias. They just go in there and they trade intraday volatility. While I think that's cool and it teaches you a lot of things, I'm going to give you the components of that where you can go in and out of any market and be a buyer or seller. But I'm going to more specifically teach you the strengths of being a buyer when it's really strong and institutional order flows on your favor to go higher, and when you want to sell it when it's bearish and it wants to go lower, extremely stronger. All right. So when we have the market on a daily chart, let me create a clean daily cable chart because I want to be able to show you the contrast of what we're looking for and why it's important for you to have these ideas going forward in our examples. All right, so we had the market create an old high back here, bearish order block, return to the order block, breaks down, rallies up again, trades right into the order block again here. So our expectations are that number one, any buys are going to be capped. That's the framework of why it's a high resistance liquidity run. There's going to be resistance to this pair wanting to go higher. Why? What was the resistance that would frame saying, okay, well, why wouldn't it be a strong buy back here, Michael? I got questioned by, I think, 3 individuals. Why even take this long? Because I want to show you, number one, even if you're a day trader, you can take a long, but you have to refer back to the higher time frame charts because they're going to give you where the barriers are for price moving higher or lower. We've already given you the weakness that would be expected with these areas. We drop into a 4-hour chart, these areas refine even more. Excuse me. One, two, 3 candles on a 4-hour basis. That would be a 12-hour candle, which we don't need to have a 12-hour candle chart. We just need to understand what the order flow is that's being shown here. This rally up, this whole movement in here, that was the basis of what we were buying off of. We were buying in this area over here on the down candle right for this up move. We went long in there at 132.02, and it's trading higher, 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 up into this up candle, right into the middle of this up candle. Okay, middle of that candle comes in here. Look at the body of, I'm sorry, the wick of that candle. Okay, see that? Comes in at 132.52. The low comes in at 132.53, and it's right at the middle point of that candle. So when we see that, chances are it may want to spike into that. That's all I was going to try to do is show you how just getting above that would give us another profitable exit, which is why I told you I have a limit order, and we were expecting a run on 132.50s still, and if we get a spike, we'd look for 132.80, okay, and then that would be a rejection, and we would see the breakdown. That's what I was anticipating. That's what I wanted to see happen, but it never gave me the 132.51. It just stayed at 132.50, so I didn't get anything above that 132.50. So this is one instance where, and it's going to happen in your own trading. You're going to have a game plan. You're going to have an expectation. You're going to have a trade in mind. And if you don't pay yourself when you can, these are the times when you would have regretted it. Say I didn't do partial profits as it went up. This would have been a complete wash. You'd have nothing come out of it. Nothing would have been profitable in terms of your experience or managing the idea that you're trading in. So you have to take some profits out as you can. This way, it frees you up to be wrong, and you still are profitable, and that's what it boils down to. But when we saw the Friday's open, we saw the market give us an indication that it wanted to move lower with the gap in here, and it gapped down, okay, showing you what does it want to reach for. If it's in this small little consolidation, and it's gapped down when the news came out at 8:30, what's it indicating? It's in a rush to get down below this low. and we mentioned this on Friday, there's only been one little dip down here, price swing. There's not been a lot of time. Look how many candles. This is a 15-minute time frame. There's only been a couple hours that it used to make that low. Contrast that with all of this price action in here. Okay, it's more efficiently traded. It's spent more time in there, so it's not really a level of thin support or resistance. It's a lot of consolidation in there versus something like this. So when you see that in your charts, you're going to know when we look at running out highs and running out lows, this is a low resistance liquidity run. It has very little barrier to it. So we're going to see it drive lower below that. Now, I also gave you on Friday during the live session, I told you how to use the economic calendar to frame how the daily range is engineered. Now, if you don't recall, go back and watch the recording when we're done here. I talk about how the economic calendar, when there is a news release that releases at 10 or 11 o'clock in the morning New York time, when you have a 10 o'clock news event in the New York kill zone, okay, in other words, between 10 o'clock or 11 o'clock in the morning New York time, that takes you past the 10 to 11 profitability or profit-taking hour. In other words, usually the daily high or low is formed in London open. And then whatever that day is, if it's bullish between 10 o'clock in the morning and 11 o'clock in the morning, if it's a bullish day, the low is formed in London generally, and then a high is usually formed between 10 o'clock and 11 o'clock in the morning New York time. If you get news at 10 or 11 o'clock in New York session, there is not going to be the daily high formed between 10 o'clock and 11 o'clock in the morning. It's going to go all the way through to the 1800 to 1900 time period. If we look at the daily range defined by the MT4 platform, this is by hold down control and tap the letter Y, and you'll get the daily delineations. But that's set up for Asia or 0 GMT, okay, or 8 o'clock in the evening, my time, and then it trades forward. Well, if we use true day format on Friday, there's true day on last Friday, and keeping him the same parameters I started with when I started this teaching mentorship, the 19 or 3 o'clock in the afternoon New York time. That's the end of the day, of the financial day, and the beginning is midnight or 4 on the Forex LTD demo account that we use. Market expands all the way through 10 o'clock in the morning through 11 o'clock in the morning, all the way down, boom, it creates a low. Now, yes, it does one more time just go below it, just by a little bit, but does it go 50 pips below it? No. Does it go 20 pips below it? No. The low comes in at 130.03. The low comes in here at 129.99. It went 3 pips below it and then finally turned around. Okay? So when we look at the economic calendar, you need to keep in mind that the daily range, when it's expanding, if you're bullish, actually, let's use the context of it being bearish because that's what we're talking about here for cable. If you're expecting the candle or the daily charts candle to be bearish, okay, it's going to start off slow in London, okay, and you look at the economic calendar, okay, it's going lower, lower, lower. If you watch your daily candle form throughout the day, it starts off getting bigger and bigger and bigger, and we sit in a small little range going in between 5 o'clock in the morning and 8 o'clock in the morning New York time. Then usually you'll start seeing it come off the low a little bit, and then you'll see a small little wick down here. Okay, that is the low that's formed. Okay, there's going to be all kinds of orders that stack up below that low that would be there. They're going to run those out, and they're also going to run for a higher level liquidity area. When we expect price to expand with low resistance liquidity runs, which is what this cable was, in contrast to what this high resistance was, you look at the economic calendar, okay, and you see if there is a news event coming out 10 or 11 o'clock, or when we mentioned before, everyone knows this one because I did it in pre-teaching stuff, if there's FOMC, which usually comes out 2 o'clock in the afternoon New York time, that will prevent the daily high or low forming between 10 o'clock in the morning and 11 o'clock in the morning New York time. So my question is this, in closing. If we know that there is an event on the economic calendar that's high or medium impact between 10 o'clock or 11 o'clock in the morning New York time, do we take all of our trade off between 10 o'clock in the morning and 11 o'clock in the morning, or do we leave a portion of it on to see how far it will go into later parts of the day, like we described on True Day? Look at I mean, seriously now, look at the definition of this entire daily range. It's the entire lion's portion of the move. The entire daily range is encapsulated between the two time delineations I've given you. So if we're looking at news events that are going to be driving liquidity, okay, and it's occurring at 10 o'clock to 11 o'clock in the morning New York time, leave something on. Leave something on. Now, how can we use that same information in reverse? If there's no more economic news after 8:30 in New York time, and there's nothing late afternoon for FOMC, and nothing at 10 o'clock to 11 o'clock, there's no more news events, dollar-based or your currency-based, that you're trading. If no events are left on the economic calendar after the news embargo lifts at 8:30 in the morning, okay, that means the news is already priced in, the liquidity's already ran. Then and only then do you take a big portion or all of your trade off between 10 o'clock in the morning and 11 o'clock in the morning, because that's going to be the opposite end of the daily range. If it's bearish, what's going to happen is it's going to expand down on the daily chart. The candle's going to get bigger, and it's going to expand down into 10 o'clock, into 11 o'clock in the morning, and then it'll ease off, and then close a little off the low between 10 o'clock and 11 o'clock in the morning. So that's when you want to trust taking your profits at 10 and 11 o'clock in the morning, because that's going to encapsulate that daily range. If there's news at 10, 11, or later in the day FOMC related, New York time, then you cannot shortchange yourself by taking positions completely off, or at least not keeping at least a third of the trade on, just to see how far that daily range will expand, because that later news event after 10 is going to drive liquidity even further than you thought it was going to go. And Friday's an illustration of that very thing happening. So we will be talking more about these things, obviously, as we go along. But I wanted to talk about the effects of the economic calendar, why we were saying the 10 o'clock news event and 11 o'clock news events are influential in terms of engineering the daily range. Now, even if you're not a day trader, if you're not day trading, say you're in a position that you are, well, let's say we're short, say you're a bear. Okay, say you're shorting cable up here, and you saw this move here, and it starts to retrace a little bit. Let me get this off. Okay, and you saw a little bit of retracement in here, and then all of a sudden the market starts to break down, and it takes this low out here. But in the time of day that this is occurring, there's lots of daily range left, and you have that understanding of how the liquidity will still be injected because of that news event that happens between 10 and 11 o'clock, like we saw on Friday. And then it drives even lower, running the stops out here, and ultimately even lower than that on this low here, which we mapped out on the 4-hour chart. So it gives you a lot of mile markers, if you will, while you're managing your trade. And these are the things you also have to have in in your mind before the actual trade begins or before you put the trade in, because you have to have scenarios that are written out. They have to be written out in text and format where you can read it. It can't be just little squigglies on a line. You have to have a marker in terms of where is the trade no longer valid, okay? And you'll learn all those things through this mentorship on every individual trading concept that I teach, whether it be day trading, swing trading, short-term trading, position trading, all that stuff. They all have specific rules. They're not ambiguous. They're not, well, this sometimes works like that. No, there's very, very specific things that I actually put money behind. But if you're patient, you're going to get to that. But I can't give it all one time. I'm giving you one piece, one component at a time, so that way we can learn it intimately and then go on to the next level. I don't want to have to go back to look at order blocks and mitigation and propulsion candles 6 months later. I want to make sure everyone understands exactly what there is to know about it, then move on. Some of you have been with my material for a while and you're thinking you're advanced. That's not advanced. You just know a little bit more than everybody else in the retail world. That's not advanced stuff. Okay, the free tutorials, that's not advanced. That's just getting you into the framework of where we're going. You need to have that to understand where you're going to be at in the 7th month. So looking at what we're seeing in price action, we're combining time and price. We're looking for the volatility injections relative to what the market makers and the institutional order flow is going to be victimized or capitalized. Okay, in other words, are they going to run stops, or are they going to add more to a position that's underlying, that's been moving already? An example would that be they sold here, they redistributed into bearish order block, expanded, and then redistributed it again, and an expansion lower. It runs quickly for the liquidity below the lows over here. Once it does this, are we in a hurry to get back in the marketplace? No. Why? Because we just had a big range. Everybody else is chomping at the bit because they saw that big move last week. They all want to get short today, and look what's going on right now. It's trading back up. And that's the biggest thing that I got beat up with when I first started trading. I was like, wow, it's really moving up, or it's moving down, and I want to get involved in that. And then I would end up, selling the low or buying the high. What I want you to focus on here as we go into Tuesday is this is where the bodies of the candles are here. We want to see a willingness to keep price at bay, or not want to get above the blocks of these candles, or the bodies rather. And prices so far had a willingness to keep that at bay. If we go down into an hourly chart, you can see that that's what we've done. We've went above this little bit of a bearish order block, but I wouldn't even consider that a bearish order block because we, on a higher time frame, we cleared out a level of stops below here. So they're going to recapitalize that area in here and mitigate. And mitigation is whatever you saw over here will be reversed over here. And in simple terms is support broken is now resistance over here. So that's what we're expecting. Okay, we would like to see it give some kind of a framework where it wants to not go any higher, and then allow us to get a short on based on whatever the interest rate announcement is on Wednesday. So we will still be sitting on our on the sidelines through tonight and during Tuesday. Why? Because interest rates are on Wednesday. Okay, so we'll be taking action on Wednesday after the announcement is released, and we'll trade the volatility that's available then. So between that and now, we're just going to be talking about conceptual ideas, teaching, using hindsight, because I don't have anything that I can give you, and I don't want you thinking that I trade ahead of interest rate announcements like this very frequently, because I don't. If there is something, I will trade it, but I don't want you thinking that I'm always in there doing that. So the point of this mentorship is to see what I do with my own money, and we're doing that on a daily basis. So looking at The we looked at dollar, we looked at euro pound, we looked at euro dollar, we looked at cable. I already covered what I wanted to cover in regards to the high resistance liquidity run and low resistance liquidity run. Let's look at Aussie dollar. Okay. And I promise this will be it and we'll close it. Some of you are like, keep going, I'm all right. I got things I got to do today. So the so we had the market break a swing high in here, expanded. Okay, what we wait for is we want to wait for price to come back down into what? We talked about this past weekend. I gave you the tutorials. You want to see price move back to equilibrium and then below it for discount. And where will it trade? For discount, it's got to be in the 62 to 79% retracement level. Now, once we understand that that's where the market will want to go, and then banks should step in at that moment and buy it at that discount. If it does that, okay, where do we look to take profits at? If we take a long on an idea like this, based on what I've shown you Saturday in the tutorials, okay, old highs, they're going to look to take their profits there, okay. So if the banks are capitalizing new longs in here, how do we know they're going long? Why would they want to be buying? Because they've already shown us a willingness to want to take the market higher. It retraced a little bit, okay, and then what? It expands. It takes out this high here. So if they bought here, they can sell to willing buyers that are short with their buy stops being triggered right there. And then where's the next area of liquidity? Over here. So the longs that they have established down here, they're going to want to take these highs out that are equal, and they'll punch right on through that, and it's still a little bit of time. It's only quarter after 10 in the morning, my time. So we're going to look for a run on 75.70 to 75.80. This would clear that level out. If we get expansion, and say it catches a lot of momentum, we have this up candle right in here, so we have to watch that. Okay, so if we get legs, it could go up to 76 big figure, 76.10. I don't see that happening today, but when you see like this is really fun. When you have that, go down to a 5-minute chart right before we see a run on liquidity. And you can, what am I doing here? 15-minute chart, Michael, not 5. You can watch the range. It looks like it's making a high, but when you're on these lower time frame charts like this, you don't see what we just shown you. So this looks like a high. People are going to say, okay, this is bearish. Let's put up my my handy dandy stochastic, and it should give me a bearish divergence in here. It's been diverging all this time here, and it's making higher highs, higher highs, higher highs, higher highs. If you pull up a RSI, this is a retail trap, by the way. That's why I'm showing it to you. Okay. Oh, look at this. We have a bearish divergence here in the RSI. We're overbought, so there's no way in hell that the Aussie dollar is going to go higher, right? I mean, there's no way. There's just simply no way because the indicators say that it's not going to go higher. But I just showed you on the hourly chart where the liquidity is, and retail is going to have its ass handed to it in a couple minutes here. So don't think that while you're learning intraday charts because of examples that you're not going to have an understanding of what to expect in price. You'll know exactly what price is going to do on the near term. That's the only level of clarity I can promise because I'm very good at it. Long term, I already admitted that. That's my weakness. But for now, I want you to understand that these things repeat over and over and over again, and they repeat themselves not only in intraday charts, but they repeat themselves in every time frame. Every time frame. So let's just watch this one real quick. I want to watch them blow out the 75.75 to 75.80 stops. But they would the longs that they accumulated down here, and I mean, I'm I'm probably offending some of you guys that really like these indicators, but I warned you ahead of time. Don't think that your indicators are driving price, because they don't. And I know it feels bad hearing that, because I had the same feelings when I was learning. I was like, what? This isn't how it's working. And if it doesn't work by indicators, how could I possibly learn how to time the market? If it ain't going to be done with an indicator, because that's what indicators do, right? They indicate that you need to be buying or selling. If that's not going to help you, what in the hell is going to help you? Understanding price, focusing on price. If you understand that, you'll know everything you need to know. The open, high, low, and close is the secret. That's the secret. That's the inside secret to the industry, knowing what that open, high, low, and close tells you. So again, we have a willingness to run away. Okay, it comes back down. You measure the range, low to high. It has to get down to equilibrium to show your willingness to go to a discount, and then you watch price go below that. If it does that, you have a opportunity. It doesn't mean you have a trade. It just means you have an opportunity. Then you have to say, okay, if this is at a discount and it is most likely going to be bought by the bank, where would they want to take price to unload whatever they buy down in here? So if they're buying, let's make it green. If they're buying in this area in here, okay, then for them to be profitable, are they going to look for a 10 pip move? No. Banks are not interested in 10 pip moves, okay? They want to see movement. And that's why I'm trying to tell you, by focusing on movements that have the potential payouts of 40 pips or more, if you do those ideas, then you'll easily have context to trade with a 20 pip minimum expectation. If I can't get 20 pips out of it, I'm not even worrying about it. And I've learned that if I don't see at least 100 pips potential range, I'm not going to get my 50 to 75 pips weekly objective. And yes, that's all I look for. That's it. So between where we're looking at down here as a potential buying area in discount, up to this high here, if we blow through the high, it's about 50 pips. If we get above this high over here, it's 90 pips. 90 pips if it sweeps above that high. If it gets up to 80, it would be, if I can get it to squeeze in there, it'd be 99 pips, 100 pips basically. 100 pips if it could spike up to 75, 80. So when you're looking at ranges, you're not just simply looking at, okay, well, it moved up here and it's retracing. That's not a trade unless it gives you favorable risk to reward between where you're wanting to buy at, where the stop has to be, and how much of a payout it needs to be. Again, you want to frame trades that give you preferably 3 to 1 or better, because you can be really not accurate at all and still be profitable. But if you're trading with 5 to 1 conditions, that gives you an enormous edge where you can take a lot more frequent setups that have that gearing where you have potentially 5 to 1 paid to you at risk of 1. So if you're making $5 for every $1 you risk, the ratio that's necessary for you to be profitable with accuracy, you could be wrong a lot in those conditions and still be very, very well, very well. So when you're looking for trades, that's why I tell everyone, if you're going to take a trade, try to frame it on an hourly chart, because the hourly chart will give you context to get you at least 50 to 75 pips, easily 100 pips if you're looking at the right swings. What is the right swing, Michael? That's the missing piece of the puzzle. I've already told you, but you're not listening. You want it to be plastered on your chart for you by me. I'm telling you how to go in and find it. So if you work in an hourly chart and you see a price range expand from a low up, then you start following it. Does it want to go back down below the 50% level of that range? If it does, start watching the 62 to 79% retracement level. And then if it lines up with an order block, between those two reference points, an order block, it's below 50% of the range it just created. Once it gets down to this, the 62 to 79% retracement level, you weigh out in terms of measuring where that would be a buy to where the high is. If the high it just dropped down from is only a very small range in terms of pips, is that something you want to be a part of? Maybe for practice, but if it's a considerable amount of pips, and again, it's got to be 40 pips. It has to be 40 pips. Now, why? What's the magic with 40 pips? Because even if it goes up just below that low, okay, I'm going to be looking to take profits before I get to that high. Remember, I'm taking profits early. I want to get paid. I don't like being in a trade that doesn't give me any money. And you won't like it either if you start trading. It's nothing more annoying than being a part of a move and you never got anything out of it. So if we understand that range, once we have identified the equilibrium price point here, we dip down below it. We went into what we define as optimal trade entry. Price has to expand from an area of entry in here. We're going to say we bought at the high end up here in this portion of upper 25% of that range. To the old high back here, that's 40 pips. That's the criteria I look for. That's it. It has to give me that much of a range, because even if I get profits early, 20 pips down here, it's only got to move that much to give me 20 pips. That's it. Then I'm already first profit. I'm paid. So I don't care if the trade turns around at that point. I can't lose any money. There is a free trade at that point. Until then, it's never a free trade. But then you take another portion off here because you don't know if it's going to turtle soup that. In other words, if it's going to go just above that high and reject and go into a long-term consolidation. You don't want to be in that either because you're spending mental capital. Then you aim for the objective that you really are aiming for. This is just the first objective to fund your trade, and then once it takes this high out, then you can take your stop to a break even. But you can't do it before that. Then you allow the price to expand up to your real objective, 85 to 90 pips. So the risk, if you're buying here, your stop's got to be below the low you anchored your idea from. So there's 20 pips, a couple pips below that, 25 pips. So you're risking 25 pips to make as much as 100 pips. So that's what, 4 to 1. It's not bad. It's hindsight here, but I'm giving you context of what I look for. So watch this one today, and go through your charts also using the hourly chart. Focus on the hourly chart. Look at price swings on the hourly and measure those out on buys and sells. Focus really primarily on the buys because that's the only thing I've taught so far. Buying from equilibrium to equilibrium to discount. But then if we're doing that, you already know where to get out at. You already know where the market is going to want to go. If you're buying, they're going to take it above an old high. They want to get people selling down here while they're buying it from them. And if they're long, think like the bank. If they're long, they don't want to get profit, okay, just 10 pips. They want to take it where the market is already advertising willing buyers. Buy stops above this high. Buy stops above this high. You'll know by experience doing this over and over and over again that that's how the market operates. It's not anything else but just this. Where's the money? Because the bank can only get their positions off if they can knock funds out or go after their stops. They're not after little old me. They're not after little old you. Okay, that happens inside the broker. But they are after the large liquidity pools that are resting in the market because of the large trading funds. And that's all it is. There's nothing else out there. It's not indicators. It's not moving averages. It's not supply and demand zones. It's not anything else but this. That's all it is. If you know where the money is resting in the marketplace, you understand equilibrium and discount to premium, all you have to do understand after that is time and price. If you put those things together, you have what it is that makes me ICT. That's it. There's nothing else. The only thing that's missing is how to manage your money. Don't risk too much. How to scale in, scale out. Um, when to push it hard. When do I go with 3.5% risk on a trade? And the other time it's 1.5%. So all those things will be taught to you, but you'll trust me. You'll be fine. Okay, you'll do very well. But for now, just take the steps that are being placed in front of you. It's not much homework. It's not much the slave over, but there is a lot of patience that's going to be required. And some of you are already showing you don't have that yet, and you're going to need to develop it, because I'm going to be very frustrating for you, because you're trying to get what would be delivered in 12 months in 2 weeks, and that's unrealistic. Okay, so I'm going to close it here, watch this one unfold, and then we will get back together probably. I might do something in Asia tonight. It depends on what my wife and children want to do. If I get an opportunity, I'll have another session, this Asia session tonight, probably around 6 o'clock my time. If it is, it's going to be short. It won't be nothing lengthy. But if not, we will be back again tomorrow morning at New York. I'll send another link tomorrow for tomorrow's session. I'll send it tonight and before 9 o'clock tonight, so that way you'll all know it'll be basically the same time it is today, and we'll go through some more teachings, because again, we have interest rates on the looming horizon, so we are all sidelined. We're not trying to do anything crazy, but we still can operate inside the marketplace and give teachings. Okay, and then we will be looking to take action on Wednesday. So with that, folks, I wish you a very pleasant afternoon, and good luck and good trading in your demo.